We're seeing the death of dividends, with even companies that have paid out decades of yields cutting their cash payment. In this video, I'll show you how to find the dividend stocks you can count on to produce that cash flow. Then I'll reveal the very best 5 in the Dividend Aristocrats you can buy and hold forever. We're talking dividend investing today on Let's Talk Money.
Beat debt,
Make money,
make your money work for you.
creating the financial future you deserve.
Let's talk money.
Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now Nation, you know we love dividend stocks here on the channel. Not only do these companies that pay dividends just tend to outperform the rest of the market, these stocks are truly the best investments for that cash security and the financial freedom you need. Now, stock prices are a roller coaster of stress. The market crashed 35% this year, only to surge back 30%, all within a 2-month period. And it's in times like this that it helps to focus on those dividend stocks. Watch those checks come in to take the stress out of that market. But you can't just invest blindly in dividend stocks either. More than 135 companies have already cut their dividends this year. Analysts expect companies in the S&P 500 index are going to cut their dividends by an average of 32% in 2020, and more than the 29% dividend cut we saw during that 2008 recession. So what I want to do in this video is to show you a group of dividend stocks with a history of commitment to cash return. A group of stocks that have not only paid dividends, but have increased those payouts for 25 consecutive years. I'll explain why these dividend investments beat the market and how to find the best of the best you can count on to never cut. Finally, I'll reveal 5 best stocks in those Dividend Aristocrats that you can buy and hold forever. I'll leave a clickable index in the video description below if you want to jump over this basic information first. Also, I want to put this out to the community though. Do you think we'll see higher or lower stock prices by the end of this year? So just scroll down and let us know in the comments below. Do you think the worst is over for this stock market crash? The Dividend Aristocrats is a name given to the stocks in the S&P 500 index that have not only paid dividends, but they've increased their payouts for at least 25 consecutive years. And I like to use the ProShares S&P Aristocrats ETF, that's ticker NOBL here as an example because it invests directly in these stocks. The fund adjusts each year, adding new stocks that make the list and then dropping those that couldn't make the cut. It's got some great companies here like Clorox, Walmart, and Kimberly-Clark. The group pays a 2.4% dividend yield, which is about 20% higher than the broader market average, and it's surprisingly well diversified across sectors. You can see in the chart here, it's a little heavily weighted in consumer staples and industrials, but then it has a solid mix in those other sectors of the economy. And besides that consistent dividend payout, this group tends to be less volatile compared to the rest of the market. These are older, more mature companies with stable cash flows and solid fundamentals. And management knows that it has to meet that dividend payout no matter what, so that cash discipline tends to force them to make better decisions. Now the question, of course, you're probably asking, why not just invest in that Dividend Aristocrats fund and be done with it? And we have looked at the fund before on the channel. I love the ease of investing, just buying those shares of the NOBL and getting all those aristocrats. The fund rebalances each year, so you don't even have to follow the group. You just invest once or keep putting your money into it. But anytime you're buying a fund in a theme like this, you're going to get the weaker companies along with the best. Just because these companies have a long history of dividends doesn't mean that they can't fall from grace. In fact, this chart from Sure Dividend shows the Dividend Aristocrats list of stocks from 1989 to 2020 and just how much this list has changed. More than 100 companies have been dropped from the list just in the last 30 years. General Electric dropped out in 2009, Bank of America in 2008, and even Family Dollar dropped out after 14 years in 2015. Now, I will say that I do like the Dividend Aristocrats fund for a small part of my portfolio. The ability to diversify across all those stocks with just one fund. But I also think you should pick from the group some of the individual stocks just to target those best companies. So I want to walk you through how I narrowed this list down of Dividend Aristocrats. Then I'll reveal those 5 best dividend stocks that you can buy and know that they're always going to produce that cash return. So first here, I'm looking for companies with a competitive advantage in their industry, and I'm measuring this really on 3 things. I'm looking at the operating margin, so the operating income divided by the sales. Both of those are found on the income statement of the company. And those of you in the Bowtie Nation know this is my favorite measure in stocks. And the operating margin is the amount of sales left over after paying for those materials, so the cost of goods, and all those operating costs to run the company. Then you take those operating income divided by the sales for that profitability metric. This is the single best measure for how well management is able to turn those sales into profits, much better than the bottom line earnings that everybody looks at or that net margin, because that's going to include all that leverage and tax effect that they have thrown in there. So I'm also going to be looking at the overall sales growth. Besides that profitability, I also want to find companies that are able to grow their revenue faster than the competition. Finally here, I'll look at the strength in the company's brands and how much market share it has versus its competitors. In fact, a lot of this is just going to be evident in the operating margin and those sales growth numbers. A company with a strong brand that customers love is going to be able to charge a higher price, which is usually going to mean a higher operating margin and profitability. It's also going to be able to increase those sales at a faster pace and take more of the market from its peers. Next here, and I think this is one of the most important, but also one of the most overlooked factors in investing in those buy and hold forever stocks, I want to look for companies and industries that are going to be around forever and look for those universal trends that are driving the economy. And the problem with that is that while a lot of these might be great companies now, their industry is under attack and won't be the same in 10 or 20 years into the future. And a good example of this is oil producers like Exxon and Chevron, both great stocks, and I actually own both of these companies, but these aren't companies that you can just stick in your portfolio and not look at for 30 years. These might be great rebound plays right now or for the next decade, but not a part of my forever portfolio. Now, just to take that a step farther for the Dividend Aristocrats, you've got a lot of companies in the retail space like Target and Ross Stores that have been able to hold on to the aristocrat status, but I'm not sure for how long. So for the 5 stocks that I'm highlighting here, besides that competitive advantage and the financial strength, they've got that long-term survivability that you can count on. Now, I've also picked these 5 from different sectors and industries to give it that diversification and safety. Our first pick here is a favorite among investors, AT&T, the $208 billion telecom giant, paying a 7% dividend yield. Now, if you've been following the channel, you know I haven't always loved AT&T, but I'm starting to come around on where it's trading at now and some recent moves by management. The company only has about $12 billion in cash versus a mountain of $150 billion in long-term debt. And I'm not a fan of the acquisition strategy over the last few years, but management has been aggressively paying down that debt, paying off $11 billion in the last year alone, and the dividend is about as safe as it gets. The dividend is going to be about 60% of earnings this year, so higher than previous years, but there's plenty of cash flow and savings from that paused repurchase share program. Now, shares are trading at a price around 8 times earnings, and the stock is down 25% from its 52-week high, so maybe a little bit of a value play here too. AT&T books an operating margin of 16%, which is on the high end for its industry, and the company doubled its net additions for wireless customers in the first quarter. That's versus last year. Next on our list of best dividend aristocrats is Colgate-Palmolive, ticker CL, and its 2.6% dividend yield. Clorox just reported a 7.5% surge in first quarter sales. Now, that's unheard of for household products. This one is definitely getting a boost from those higher cleaning products purchases. I mean, the name is practically synonymous with bleach. And Clorox has a solid lineup of brands too, with 17% of the home product segment and controls more than 32% of the worldwide market share for toothpaste. The company books an operating margin of 23%, also one of the strongest in its industry. Now, the balance sheet with just $880 million in cash against $7.3 billion in long-term debt isn't great, but this one is actually benefiting from the pandemic, so I'm not quite worried about the financials here. Shares of Clorox trade for 23 times earnings, and the stock is still down 12% from its February peak. Ecolab, ticker ECL, isn't as well known among some of those other aristocrats, but this is a solid long-term investment that's nearly doubled the market return over the last 5 years. Ecolab is the global leader in cleaning and sanitation products for the hospitality, healthcare, and industrial space. It's a very fragmented market here, but the company controls about 10% of that $130 billion global demand, which gives it the pricing power and the scale that you just don't see with its competitors. And those size advantages really show through in that 15% operating margin, which is increasing on some of its efficiency programs. Your shares trade for a little expensive here at 32 times earnings, but this is a strong long-term dividend growth story. Now, Ecolab does only pay about a 1% dividend yield, which barely qualifies it as a dividend stock, but the total return on this stock is almost double the market return over the past 5 years, and I think it can continue to outperform. Automatic Data Processing, ticker ADP, is the largest provider of corporate payroll services in the United States and a global leader in the space. Nation, companies are increasingly looking to outsource their human resources and their payroll services, and ADP has the scale to deliver on this with over 650,000 clients worldwide. In fact, ADP is nearly 4 times larger than its next biggest competitor, Paychex. Now, the company is expected to take a hit on the recession this year, but a lot of those mid-size and the smaller clients, they just don't have the capacity to do their own payroll services. So that's going to protect ADP just a little bit. The company books a 22% operating margin, which jumped more than 2% last year on cost-cutting programs, and the balance sheet here is pristine. ADP has $2 billion in cash against just $2 billion in long-term debt, so it's a debt-neutral financial position. Now, shares trade at 24 times earnings and pay a 2.5% dividend yield. Lowe's Companies, ticker LOW, is the second largest home improvement chain in North America. And while Lowe's does trail Home Depot a little bit in market share, I like the fundamentals here, and the dividend history is excellent. And that said, I do think that Lowe's is probably the riskiest of the group on that short-term basis because of all those store closures right now. Also, the company was in the middle of a major restructuring, overhauling its supply chain and technology. That's going to mean better profitability in the future, but it was expected to cost over $1.6 billion in capital spending this year. Now, I expect management of the company to scale that back a little bit just to protect cash flow, but it's also going to push those returns on the program back another year or two. Lowe's has 50 plus years of dividend history though, and the home improvement category is probably the single best in retail to survive that death by Amazon trend. The shares pay a 2% dividend yield and trade at 19 times earnings. Want to get paid on your stocks every month? Click on the video to the right for a monthly dividend stock portfolio that will put money in your pocket every single month. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.